Everybody, welcome to today's webinar on charitable strategies that your CPA probably won't tell you. I think I've met most of you. Welcome, good to see you here. Some of you haven't met before. My name is Francisco Sirvent. I'm the founder of Keystone Law Firm and Lifestyle Planning. And we do these webinars as often as we can just to share ideas, strategies, things that we hope you can use that are practical for you to just take home and do something with. Or even if you already knew about them, you can think, wow, I already knew that, and just feel more certain with what you're doing. So check our website. We always have upcoming webinars. It's keystonelawfirm.com/events. And you can register for any of the upcoming ones right there. The ones that are posted there are free to attend. This online system I don't think it has a limit to the number of people who can attend. So you're welcome to attend anytime. You're welcome to share with anybody that you know. I will just give you a couple housekeeping tips. We do record these and we share them on our YouTube channel afterwards. So if you see a topic that you want to hear, but you can't attend the live date, then look back at our YouTube channel. It takes us about a week to get it up there and posted, and see if it's posted on our YouTube channel, and that is youtube.com/Keystone Law Firm, and you'll find these posted there complete. The full 45, 60 minutes, whatever it was. The benefit of attending live is we try to save some time for some Q&A, so you get to have the benefit of that. But because we are recording these and we do post them for the public, if you do have questions, make sure they are generic enough, hypothetical enough that you don't reveal anything about yourself that you don't want posted on YouTube. I can take questions by chat throughout. I'll try to watch that and get answers as we're going through, but I'll definitely have a little bit of time at the end to do live Q&A if you have questions. So, and then our very next one, I just want to go ahead and plug that one, is it is on February 11th at 9 a.m. My partner Michelle Dexter will be presenting that one. Really good topic: how to talk to your kids about your estate plan. So if you aren't quite sure what to share with them, but you feel like you should share something, that would be a great one to attend. It'll give you some great ideas, things to consider. And Michelle will be presenting that one live on February 11th, 9 a.m. At the website. Again, you can register for that to get the link. So here we are, start of the new year, a few weeks in already, and already talking tax strategies. And the main reason that we talk tax strategies now is because you want to know what they are before the year is over. So before we dive into the content, this is general information of an educational nature. This is not legal advice, tax advice, financial advice for you or your specific situation. And all the full disclosures available at retirementmo.com. Lovely. With that out of the way, it was quite a few years after becoming an attorney before I really learned the professional difference between a CPA and a tax lawyer. And do not take this as me saying anything negative about CPAs. A good CPA is amazing, and they are phenomenally helpful with what they do. The U.S. Supreme Court very clearly explained what it is. Their license is as a public accountant, and that public, the word public, does have very significant meaning. And so this is, I learned this over time. This is why CPAs don't regularly get trained in their profession to do proactive, strategic tax reduction planning. It's because their duties are to the public to report things accurately and according to the tax rules. Their allegiance is to the public, and the Supreme Court said that very clearly. Whereas a tax attorney only has one person they answer to, and that is their client. An attorney's duty is to the client and is to present their case or their information as favorably as possible. And a good tax attorney will also help you think strategically about the tax code out there. So I love sharing tax strategies. I love saving tax dollars. You know, me and my wife, we use as many as we can to save as much tax dollars as we can. I am never ever interested in you know tax strategies that are going to end up, in trouble with the IRS. I have no desire for that. I want to be above board on everything in my personal life. So the tax strategies we're going to talk about, they're very vanilla. They're very time tested. They're right in the rules. There's not a lot of complication to implementing most of these. And I really hope you can walk away with at least one or two nuggets that you can think about this year. And you can think, you know what, I can implement one or two of these and maybe save a couple $1,000s, maybe save 10,000, maybe save $50,000 in taxes. And for every dollar you put back in your pocket, every tax dollar, it's tax-free money. So we all like tax-free money too. So today's tax strategies are all focused on charity, and I really, there are a lot of people out there that talk about tax strategies and they use charities to get deductions. I'm more of the type of, I don't know, strategist where I like to say, if you're already charitable, then make sure you're getting the most tax benefit from your charitable giving. It makes a difference how you use your charitable gifts, how you make them. And so if you're not already doing something for charity, or you're not already including charity in your state plan, there may not be a lot of nuggets here for you today. But if you already are charitable, you're already giving money to church or the Red Cross or other, organizations throughout the year, you're already maybe leaving something in your estate to charity. These are going to be a few ideas for you to kind of supercharge those and make sure you don't get the minimum tax benefit that the IRS gives you for doing that, but you get the maximum tax benefit that you can get out of it. So that's what we're going to focus on today. I think I have four strategies we're going to talk about. The first one is, I'm calling it the destructive standard deductions. So 2017, the tax law was changed to raise everybody's individual standard deduction pretty significantly, and now it's indexed for inflation. And those standard deductions were confirmed to stay the law when the one big beautiful bill passed. And so we have these standard deductions going forward. For some people, this is just simplifies your tax return greatly, right? You don't have a lot of itemized deductions, and so you just get to fill in that standard deduction. For some of us, we have itemized deductions, and it's this constant game of, which one am I going to take each year? Just a quick recap of how they work, okay? So, single person has this much, married couples filing jointly have that much. So, remember the old days where you had to itemize all your deductions, right? You would keep track of your mortgage interest. You'd keep track of all your charitable gifts. You'd keep track of your state and local taxes and medical expenses, right? You'd keep track of all these things. And then on your itemized deductions, you'd report all of them, and then there would be your itemized deductions against your income, and it would reduce your income for that year, which then reduces the ultimate tax bill. We like deductions. So these standard deductions, basically, you get, if it's a single person, you get this $16,100, whether you have any deductions or not, okay? So if in a given tax year, you have itemized deductions that would have added up, say, to, I don't know, $8,000, you, on your tax return, you're not going to itemize. You're just going to take the full 16,100 because everybody gets it. Same thing for married couples. right? You get that full 32,000 standard deduction, whether you spend that in itemized deductions or not. Okay. So there's really no extra tax benefit to any of us to spend money on these things if we're not going to spend more than the standard deduction. There's no tax incentive to spend more on these things if we're not going to spend more than the standard deduction. That's what this higher standard deduction has done. I haven't seen studies yet. I'm sure there's going to be some that, say before this higher standard deduction, charitable giving was whatever, and after it, it's kind of gone down because a lot of people's charitable giving is below this amount. And that's really where we're going to kind of plug something for this first strategy. This is looking at it over a couple years. So I used 30,000 as the standard deduction, just to make my math easy for this. It's 32,000 for 2026 for married couples filing jointly. But if we look at a couple years, okay, and let's just say this is a couple, they're married filing jointly, and this year they give a charitable gift of 15,000. They have other itemized deductions of 12,000. That's going to total 27,000 of itemized deductions. Okay. The standard deduction is bigger than that. So their actual deduction for 2026 is going to be 30,000. They get the bigger of the standard or the total itemized. Okay. All right. Say 2027, they kind of have the same situation going on. But because the standard deduction is bigger, they're going to take that again. So over the course of 2 years, they've given $30,000 to charity, really charitable couple. They've had other deductions of 24,000. They've taken the standard deduction those 2 years, and so their total deductions were $60,000, which is great, right? If they were in the 20% tax bracket, that would have meant $1,200 in tax savings. No one's going to complain about that. And this is how a lot of people operate. They've got their charitable giving and their other deductions that happen every year, and they just happen every year kind of because that's when the bills get paid. The first thing that I want to suggest to you guys is a strategy called bunching. Okay? Bunching. What this means is to find a way to make your gifts or your deductions, don't spread them out over 2 years or 3 years or 4 years. Get as many of them as you can into 1 year. All right. So in this example, they still gave $30,000 total to charity. Still had a total other deductions of 24,000 over these 2 years. Their total itemized deductions is still the same. Standard deduction is still the same. But here's where the difference is. In 2026, because their total itemized deduction exceeds the standard deduction, they get to deduct the larger of that number, the larger of those two numbers. So whereas in the prior example, they only took 30,000, you can see that now, if they bunch it into 1 year, they're going to get an actual deduction of 42,000 in the first year, and they're still going to get the full 30,000 in the second year. So they've got an extra $12,000 in deductions over the course of those 2 years. Extra $12,000. They didn't spend any more money. They just changed the timing of it. And there may be other deductions you can do that with. Medical expenses, you might be able to do that with state and local taxes. There's a number of itemized deductions you can bunch into 1 year. If you know you're going to have a high year anyway, you might as well think what's going to happen next year and prepay some of those things. Now, some people are like, well, I don't want to give all my gifts from 2 years in 1 year. That's going to like the charity, they're used to getting that from me once a year, once a year, once a year. Well, one of the things that you can do for charitable gifts, which not a lot of people have heard about, I love this. It's called a donor advised fund. And it's basically your own little personal charity that you open, and they're very simple to set up. You don't have to create legal documents. You don't have to, go through this whole rigmarole of forming a charity. All you do is you go to you go to any of your investment companies and you say, I want to open a donor advised fund. And it's just an account type. It's like opening a brokerage account. It's like opening an IRA. You fill out all the new account paperwork and then poof, you have a donor advised fund. And then what you do in the first year is you say, instead of giving 15 this year and 15 next year directly to your charities, you bunch that all into the first year and you give the full amount to your donor advised fund account. Okay. And that's sits there, doesn't go to the charities yet. Okay. So once you do that, in this example, this couple puts 30,000 in that donor advised fund account. The year they put that money in the donor advised fund is the year they get the deduction. They get the charitable deduction. So if they put 30 into that account in 2026, they get that full deduction in 2026. The charity hasn't gotten the money yet. So what they then do is they go and log into their account and they say, okay, this year I want to give 15,000 to my charities. And then they just sit on the rest of it. And next year they give the other 15, or you can dole it out however you want. There's actually no requirement that you dole it out in any specific pattern. You could even leave it there and invest it and grow it. You could leave it to your beneficiaries to then distribute to charity. It always has to go to charity, can't ever come back to you. And when you do send money from the donor advised fund account to charity, you don't get another deduction at that point because you got the deduction when it went in there. Okay. So donor advised funds are a really simple, easy way to manage your charitable gifts and get some extra leverage. So this couple, they got to increase their total deductions over the 2 years, not by giving any more money, but just by timing it differently. Got to increase it by 12,000. They got 12,000 more deductions, which meant if they were in the 24% tax bracket, it literally put almost $3,000 back in their pocket. That's pretty awesome. Like, that's not a small number. That's a really simple way to put some extra tax dollars in your pocket. Now, I get it. If your numbers are higher or lower than the example, you can kind of just like scale it based on what your personal example is. But this is such a simple way to do it. You can literally just bunch your deductions, get them all to count for one tax year that is more than that standard deduction, and you get all that extra tax savings because of it. All right. So number 2, second strategy, cash is king except with donations. A lot of people just make their donations to church or charity, whoever it is, just out of their checking account. And the charities absolutely love that. I'm not at all discouraging that. There's a big difference, though, if you have something else available that you could give them. And the easiest thing to give them besides cash are stocks, mutual funds, shares of publicly traded companies. So, but like in this example, this couple, they give $20,000 in cash. And if they're in the 37% tax bracket, they're going to save $7,400 in income taxes that year, right? That's just, do the math. They're going to save about $7,400. What's kind of neat if you think about this, if they get $7,400 extra back in their tax refund, they gave the charity 20, they're getting back that 7,400, right? So the charitable gift actually only cost them $12,600 because they put money back in their pocket. Okay, so that's kind of cool. But what if they did it a different way? What if they said, you know what, we've got Paige, you asked, can you put stocks into your donor advised fund? Yeah, absolutely. You can. You can put publicly traded stocks into a donor advised fund. If you hold, some shares of P&G, or you hold shares of Tesla, or you've got a brokerage account with some mutual funds, you can put those into your donor advised fund. Here's why that's so fun. When you put appreciated stock, now it doesn't make sense if you bought shares yesterday and then move that into your give it to charity or move it to a donor advised fund. That doesn't make sense. What makes sense is if you have stock that you bought for a low price and it's now gone up. So in this second option, this is $20,000 of stock. That's the value today that they bought for $5,000. Okay, so it's appreciated $15,000. And we have a lot of clients that have stock they've bought a long time ago and it has gone up, and sometimes there's an emotional attachment to it. I don't want, they don't want to get rid of it just because of it's a company they really like. But sometimes I would love to sell this stock, but if there's just so much capital gain that's going to be triggered if I sell it, and so they don't want to sell it and pay the capital gains, right? Well, if you're doing charitable gifts, you can actually take some of that appreciated stock of the same value you would have written a check for, and you can gift that to charity. And so in this example, instead of giving $20,000 in cash, they give $20,000 of stock. Okay, they still get the same income tax savings because they get that charitable deduction. But on top of it, they don't have to sell that stock themselves. The charity is going to get the stock into their account. The charity is going to liquidate it, turn it into cash, and charities don't pay tax. So they don't pay that capital gains tax on it. They just get it and sell it, and they get the full amount. Okay. And if that gain is at the 20% capital gains tax bracket plus the net investment income tax, it could be taxed at 23.8%. And then what they're looking at is a total tax savings of almost $11,000 and a net cost of the gift of only $9,000. Huge leverage, right? And when you compare these just apples to apples, they're putting over $3,500 back in their pocket just because they didn't write the check out of their checking account, but they gifted appreciated stock. Okay, so you can do this over and over and over and over and over. Now, a real sort of another really fun strategy tied to this that isn't a charitable strategy, but is a tax strategy, is let's say you really like that stock and you kind of don't want to part with it. Well, what you do is instead of giving the $20,000 to charity, you do take $20,000 of that stock and give it to charity. You get all those tax benefits, and then you take your $20,000 in cash and you repurchase that same stock at least more than 30 days later. And guess what? When you buy it for $20,000, you've now essentially stepped your basis up to that new number you bought it for. And you get that new stepped up in basis on the stock you just repurchased. You give away the stock with the low basis, you rebuy it at a higher basis, and you just completely reset your basis so that future growth is only going to be taxed above that new purchase price. So that's something some of the clients that we work with, they get to repurchase, and they can just keep doing this little by little by little and chip away at those ugly capital gains tax bills. I really like that one. Again, it's a little more sophisticated, but all you do is you just get in touch with whoever's holding the stock for you, Fidelity, Vanguard, Schwab, whoever it is, your financial advisor, and you say, hey, I want to gift 5,000 of this stock to my charity, my church, whatever. And they should know, though you might want to tell them, that you want to gift the specific shares that have the lowest basis. So they all the custodians are supposed to track when you bought the stock and which lots have which basis. So you want to gift the ones that have the lowest basis because that's the biggest benefit for you. All right. Idea number 3 is another capital gains idea. And this one's more sophisticated. And it does take quite a bit of planning to put this one in place, but it has such good leverage on your dollars that I wanted to make sure everyone heard about it. Also, because capital gains can be sometimes a legitimate justification for why you might want to leave your overall net worth less diversified than you otherwise would have, because you're like, this big chunk of it has appreciated a lot, and I just don't want to take the tax hit in order to sell it and then diversify. And there's arguments that can be made for that. This is a pretty typical example. We have a couple owns a rental property. They bought it decades ago for a couple $100,000, and now it's worth $1 million, right? If they were to just sell it because they're just done being landlords and they want to diversify and they kind of want to get out of the rental business and just have it invested for them, if they sell that, they're going to have to pay capital gains taxes on it. If their basis is 200,000 and they sell it for $1 million, they're going to have an 800,000 gain. And their tax bill, once you add it all up, it's, we're in this example estimating a $200,000 tax bill. It's a pretty common scenario, right? So what's left for them to reinvest is about $800,000, right? I mean, they had $1 million property. After all the things, they've got now an $800,000 portfolio. There's not a lot of incentive to do that. That's a pretty expensive way to diversify your estate. So, like I talked before, you could do, this also applies to people who just have a stock portfolio or stock in public companies, or even their own, private business. If they've grown it, and the basis is really low and now it's worth a bunch, they've got this big capital gains tax bill. And it applies to all of those things. This is something that works for some people, okay? It's a charitable remainder trust. It can work for business owners, real estate investors, or you just have a stock portfolio or individual holdings that have grown a lot. Here's how it works. So you create, a charitable remainder trust, it's one of the types of charities under the tax code. When you create it, you put that rental property, those stock holdings, the ownership of your business, you transfer ownership to that charitable trust. Now, when you do that, because it's a charitable trust, you do get a partial deduction in the year that you do that. So you do get a deduction against your other income. So you get this nice deduction. I'll show you how that math works. So you get an immediate deduction. But once that is in the charitable trust, your charitable trust can now sell it, right, to some buyer and get cash. And because it's a charitable trust, it doesn't pay capital gains tax on that sale. So it gets the full sales proceeds. Okay. And then the rules require that the trust pay you a certain amount of annual income every year. It can be for the rest of your life, you and your spouse's life, specific number of years. There's options there. But that's sort of how the IRS ends up getting some tax dollars out of this. So you own something, okay? It's appreciated assets. Could be stock, could be real estate, could be your own personal business. You gift that asset, you don't sell it, to your trust. Your trust sells it tax-free. Still in the trust, it invests that money, okay? It invests it to grow, and it generates that income, and it pays it back to you, and you get that lifetime stream of income. So that's how the money flows. Here's kind of how that example would work. So this is back to that couple who had that $1 million property. So they sell it for $1 million. They pay the $20,000 capital gains tax. They've got $800,000 left to invest. Okay. If we just use like easy numbers, let's just use 5%. Let's say they're 100,000 is going to generate 5% income to them. Okay. That gets distributed to them, and that's taxable income to them. Okay, that 40,000, because it's income, right? It's growth on your money. Growth on your money is always taxable. And if we, just using a bunch of estimates, we say, okay, it's an $8,000 tax on that 40, then they get a net take home every year of $32,000 by doing this strategy. Okay, so that's how it would work if they just sold it, invested it, took some money, and what their net take home would be. Okay, if we use apples to apples and we say, well, what if they used a charitable trust? Okay, charitable trust, the first thing they're going to do is they're going to gift the rental property to the trust, but then the trust sells it. Okay, the trust sells it, so there's no tax at that sale, no capital gain. So they get to invest $1 million instead of $800,000. And if we use the same same return rate, 5%, that's going to be about $10,000 more of annual income. The annual tax bill is a little higher, but when you compare the two net take-home results, they're getting about another $8,000 a year in income after tax, just for doing the strategy. It's not a bad deal. The other benefit here with the charitable trust is that up front, the year they put that house into the trust, okay, they're going to get a income tax deduction for that year, approximately, right? The numbers have to be calculated, but it's usually about 10% of the value of the property or of the stock that's gifted into the charitable trust. So they get this extra benefit of a $100,000 deduction in year one. You don't get that every year. It's just in year one. And if they were in the top tax bracket, that's another $37,000 in tax refund. Now, if you don't need all that, you roll it forward. It gets to carry forward, so you can continue to use it and use it and use it and just chip away at future income tax bills, which is just this extra huge bonus. So that's how the numbers would shake out on a charitable remainder trust. Now, the reason why this doesn't fit everybody is because the remainder of the trust, okay, after your life, you and your spouse's life, or number of years, whatever you pick, the balance that's at the end of the trust does not go back to your beneficiaries. It goes to the charity you designate. You designate, you pick, you can change it over the lifetime, whatever, but you pick a charity and whatever's left goes to that charity. So that's why you get this big deduction up front, okay, is because the trust itself says it's going to go to charity after it's all run its course. Okay, you get all these tax benefits during your life, and a charity gets the benefit when it's done. So if you're not already thinking about leaving something to charity, then this doesn't really add anything extra to your life. But if you do, if you already have something that you're thinking of leaving to charity, and you have some stock that have gone up in value, or you've got some rental properties that have gone up in value, and you wish you could sell them and avoid that capital gains tax, this is actually the way to do it. The numbers put more money in your pocket during your life and let you have that charitable gift when you pass. So think about this and whether that might apply. The last thing I want to talk about is the IRMA cliff. So IRMA is the Medicare penalty, and if you're 65 or older and you're receiving Medicare, or you're on Medicare, congratulations, you are now staring at the IRMA cliff. The reason why it's called a cliff is because if you are $1 over or you're $100,000 over, you are getting penalized, right? It doesn't matter how much more over you are, $1, $2, $5, $10. If you're over the limit, you get hit with the penalty. So, this great, lovely little cartoon, Bill and Barb, they're super excited. They've combined gross income of $225,000. It's great. They're living their best retirement life. but that puts them over the threshold for 2026, which is $218,000. They're over by $7,000. There's, I mean, what are you going to do? I can't not take my RMD. I can't decline my pensions. I can't decline my Social Security. All those things, you can't mess with them. There's not a lot of ways to say no, thank you, and get you under the limit. With the consequence being that they're going to be bumped into that penalty for their Medicare premium. It's going to be automatically deducted out of their Social Security checks. And if it affects both of them, they'd be looking at almost $2,300 a year in IRMA penalties, and that stinks. Nobody wants to do that. They're over by 10,000. I'm sorry, they're over by 7,000. They're going to get penalized $2,300 for that. So they don't even get, much benefit out of that, because that top $7,000 of income got to pay federal tax. So there's probably $2,000 gone. Got to pay some state tax. So they're literally looking at, they got very little in pocket after tax money from that extra $7,000 that's over the limit when you add the federal tax, the state tax, and the penalty. So this is something to be looking at throughout the year. You should be really planning and knowing what your target income is going to be for the year, because once the year is done, you can't go back. Okay. And so, if you're going to do anything, you've got to do it in the middle of the year. So the fact that you all are sitting here with me at the beginning of the year, hope I'm planting seeds to really start thinking about, what is this year going to look like for me as far as my income and the other things we've talked about. Something to think about is a qualified charitable distribution. Okay. Qualified charitable distribution is, again, this was extended in tax law, and it's been indexed for inflation. A lot of good things came to the QCD strategy. What's amazing with the QCD strategy, if you are already taking the required distributions out of your IRAs, that, if you have to take $10,000 out of your IRA, that's $10,000 more of income for this year. We all know that. If you want to, though, and you don't need some of that distribution, you can have the custodian, whoever holds your IRA, send some money directly to charity. And that's why it's called a qualified charitable distribution, because it goes directly from your IRA account to the church or to your charity, whichever one you pick. Never goes to your bank account and then you write a check. If you're just doing a cash donation, this couple, if they're at that $225,000 income, they're gonna pay that Medicare surcharge. The charity receives this $10,000, but they're in the 24% tax bracket. If they just told the custodian instead to send the $10,000 directly to charity, charity still gets the $10,000, but they get a reduction of their gross income on their tax return. They actually get to reduce their gross income on their tax return by that amount, right? That's huge, because guess what? They aren't over the IRMA limit and they have no penalty. They have no penalty whatsoever. So by using that, they stay under that cliff for IRMA. They save the Medicare extra premium, and they do still save whatever the tax benefit is of making the charitable deduction. Okay, because their income is lower. These are amazing things, right? It takes some management. It takes some really looking at your numbers and what you're doing and what's required out of your distributions and all these things. Managing and watching this stuff as you get closer and closer to the end of the year will help you know, am I going to be close to that this year? The IRMA penalty has some exemptions and some ways to get relief from it if it's a one-time thing or if something significant has changed based on prior years. But who wants to spend time arguing with Medicare and Social Security over this? I know you don't. I don't. Use the strategies that just keep you under the radar completely. And those are the strategies I had for today. Charity, charity, charity. For those of you who don't know, this is the kind of stuff we help our clients and our members of retirement management office. We help them coordinate all this and figure all this stuff out with them and crunch the numbers, figure it out, make sure they're dialed in, and then help them execute this on a month by month, year by year basis to make sure they're paying the least amount of taxes as possible. If you aren't I see some people who might be. If you aren't a RMO member, you want more information about that. I do a free 15-minute phone call, and we just talk about it. There's no pressure for me. There's no catch. It's just let's hear about what's happening. Are you getting this kind of tax planning strategy in the middle of the year from your planners, from your attorneys, from your CPAs? And if you are, great. If you aren't, here's how we would do it. It gives me a chance to kind of hear what's new in your life and what's going on and whether or not we could even offer help. We don't offer our services to everybody in the world. We do focus really on people we think we can add value and we can make things better for them. But if you want to schedule that free intro call with me, I'm going to drop that link into the chat, and you can click that, find a time on my calendar right there, and I'll give you a call at that time. Take these strategies. I hope you took notes. It'll be up on YouTube probably within about a week. Go back and listen to it again. Share it with anybody else, especially retirees, and make mental notes. You might even we're about to enter into tax season before April 15th. You might even ask your CPA, hey, what about this? What about this? What about this? Ask them about these 4 things, what they think about it. I hope they know about them. I hope they can help crunch some numbers for you if you don't have anybody else who can help you. And just keep thinking about them this year. It's hard to take any of these and apply them to last year, but you should be able to take these and figure out if you can use them this year, because we're young in this year. There's plenty of time to implement this stuff. All right, I will open it up for questions, and let's see, you can welcome to turn your microphone on if you'd like. Diane, I see your hand up. If you want to unmute yourself, you're welcome to, or you can type your question in the chat.
You're talking publicly traded stocks. Can you use if you have EFT or something like that? Can you?
Yep. For a lot of these, you can. Yeah.
Oh, okay.
Yeah. Yep. You can use mutual funds and lots of those kinds of things. Yeah.
Okay. Thank you.
Yeah. You bet. You bet. You bet. Thanks for coming. Anybody else question? What if income is well over 240? The Medicare, if you're in Medicare stage of life, there's different tiers of penalties for how much extra you're going to pay in Medicare premium. Congratulations. If that's the type of question you're asking about, how does that affect it? That's there's just lots of tiers, or I think there's 4 tiers. Is there a different part of your question you were thinking about? You can unmute yourself if you want, Michael.
Hello.
Hi there.
By the way, you've done my paperwork and stuff like that, so I'm a client. Anyway, on a charitable trust, can I make my own charity and make myself the trustee of a charity?
So the charitable remainder trust that we looked at here, that is it's a trust. You write, you draft, you're the grantor, and yes, you can make yourself the trustee.
And that, because then could I make this generational?
Yes, you can make it generational, but you usually don't, and I'll tell you why. These are CRTs are set up with a fixed time period that's either based on your life or a number of years. So
Well, I'm
this
66
isn't the
years old, so
specific,
you know.
yeah, but just so you know, this isn't the specific type of charitable trust you would use to make it multiple generations. There are different types of charitable trusts or entities that you would use if you want to make it multiple generations so that it doesn't have a hard and fast end date. There are other kinds you would use for that.
I know this may be off topic a little bit, but maybe not. But is there a way of putting my LLC into like a, what is it, a 508 or something of that nature? And doing that
I've
as,
heard of 508s. I don't know that
I don't think that, I don't know if I have the number correct or not.
Yeah.
Is there a way of putting my LLC into the charitable trust?
Yeah, you can put anything into a charitable trust. The hard part about this kind of trust is if it's not a publicly traded security or a arm's length transaction, then it's going to require an appraisal, a private appraisal that would have to stand up to IRS scrutiny. But yes, you could. Yep, you're welcome. You're welcome. I see Paige put a question. Does a donor advised fund go away like the charity trust, or can it be willed down and become a family legacy? It can become a family legacy. Donor advised funds are often used exactly for that reason, to kind of create a little family legacy charity, right? And they're so simple to set up. You create them at the financial institution, just like you would open a brokerage account, all the new account paperwork, and you even designate on there, if I should pass, here's the next person who gets to control and designate charities. So yep, you can create it and it can stay there. Right now, the rules say forever. So donor advised funds are a really simple way to kind of create that legacy. Paige. Good questions. Paige asked, and everyone in the family can donate to the same fund. Yeah, there's anybody can donate to the fund. You know, you can have anybody donate to the fund. What they're donating to is essentially a fund that doesn't yet have a specific purpose. Okay, so, and you're the person in charge, so obviously there's going to be some level of trust that you're going to direct it to charities they all would agree with. But anybody can contribute. They get the same tax benefits as you would for making the contributions. You can contribute to the same account year after year or all at once. You can leave money from your estate to that donor advised fund. There's a lot of ways to get money into it. You are welcome. Good questions. We got a couple more minutes. Anybody else have any other questions? Just another reminder of the next webinar Michelle is doing, how to talk to your kids about your estate plan. Definitely come join us for that. It's on February 11th, and you can register for that and our future webinars on the website. I put the link just there in the chat box, keystonelawfirm.com/events. And then I'll give it to you guys real quick, our YouTube channel with all the recordings of prior events. And this one will be up there as well, youtube.com/keystonelawfirm. Check it out. You can subscribe to that channel and you'll just get the notifications that something new has popped up. And feel free to share anything on that YouTube channel with somebody you think that would benefit from it. All right, guys, thank you for coming. It's great to see you all. Take this information, use it, make your life better, save some money, and we'll see you next time, guys. Bye-bye.